if you've got things that you've looked at that you're worried about, I think we can probably cover those first. And then if you want me to go to the study guide and actually look at specific sections, workings, calculations, we can definitely do that as well. So I'm quite
Yeah.
flexible in terms of how you want to structure it.
Okay. Because last night I watched one of your videos. It was like 2.5 hours. So I think I've got like about an hour left, where you just sort of started and did all of the theory with this one guy. What was his name? Something
But that
about like
that might
a
have been Mac
photographer.
201. I do have Mac 206 videos as well, but they're private videos, so I haven't shared any of that
Mm,
content
no,
publicly.
it was 2602. You
Was it
spoke to this
2602?
guy
Oh, okay.
about he's a photographer, and then you used like his business
Ah, okay.
as
I'm not sure if it was
like an
2602. It might have been
example.
2601 actually, but I could be wrong. But yeah, there
No,
are
it's
some public
2602.
videos, but
Yeah, but it was only the one, and I
yeah.
mean that. But that was like I said, just lots of theory. If we can go from, I'm just still trying to get this. How do I? I made it smaller
Okay.
to get my
Yeah, I'm just
microphone on
seeing,
now.
it looks like the module has stayed the same. They've probably changed maybe
Yeah.
some of the examples and activities, but I see study unit one. This is still theory, looking at mission, values, strategy. Study unit two is also theory. Study unit three, theory.
Hmm.
Four, theory. Five, okay, this is introduction to financial management, but this is still theory based. There
Hmm.
are probably workings later on. There, time value of money. Okay, so looking at the
Yes.
contents, the first bit of content in terms of calculations would come up here. I know you said you're struggling with the calculator as well.
Yes. I wasn't sure because one of my other subjects, there's also some time value management stuff, but I
Yes.
watched a few videos and I came right
Okay,
with
perfect.
what was on the videos. So, because like sometimes, because I have a shop and sometimes they have like what is an HP. So
Yes.
I had to specifically search for shop, and then it
Uh,
wasn't too bad, doing the
yeah.
compound
The Sharp is actually quite good as
interest and
well. Casio is
yeah.
probably the best. Sharp would probably be second in terms of interface, and then yeah, the HP is not
Mm.
great, but I know Unisa promotes that HP quite often. All right, but as long as you're okay, so study unit eight, time value of money. These are all basic concepts: compound interest, simple interest, and then obviously future value, present value calculations,
Mm.
annuities. All right, so
Yes,
you
and
can let
then
me know which section do you want me to focus on.
anything from, I'd say, study unit 12, capital structure. We did, in our assignment, we had to do working capital, just like a comparison with debt equity and what is the other one? So, like I said, it's not that difficult, but if we can start with, let's say, cost of capital, that
Okay, yeah,
study
cost of
unit
capital
13 is just,
and weighted average cost of capital. Yeah, those two go together. It's actually a calculation as well.
mm.
Okay, do you want to look at those two sections?
Yes, yes, please.
Okay, let's look at 13 and 14. I don't think there's any workings in 13, but there could be. But we'll see when we go through it. They're quite short sections, so I'll give you the summarized version of it just to make sure that you're comfortable with the main
Mm.
topics. You can obviously go and have a look at the textbook theory in more detail to just to give you a bit more depth. But I'm going to cover all of it as simply as I can, but obviously covering the most important points. So, study number 13 starts on page 185.
Yeah,
Okay,
sorry, I was not 100% prepared
it's fine.
in terms of what, but I think after this class, then the next one, especially as I do more, like maybe if I do an exam, or because I want
Yes,
to go through the like 4 years exams and see, sort of focus on and see what they focus on.
yes,
Because in NISA, I've seen they don't really change it up now. Everything's online.
yeah.
So the questions, they ask it differently, or shorter questions, but
Okay,
it's sort of staying the same,
yeah.
seems to me.
When are you writing, Zonica? Do you have a confirmed date yet, or do
The
they still need to announce that?
year, no, I have it on the week of the So I'm writing the 11th, the 12th, the 14th, and the 15th of October.
October. Okay, that still gives
Well,
you
that
lots of
whole
time.
week. Yeah, so
Yeah,
I'm
it's a
writing
hectic
both
week.
Macs in that week.
Yeah, it's a hectic week when you actually start
Yeah.
writing, but at least you still have time till October
Mm.
to prepare
Yeah.
and get
Yeah,
through
I'm
what you need
starting
to.
the first, I'm writing tax and FAC the 1st and 2nd of October,
Okay.
and then that week,
Yeah.
and then the 24th of November.
All right. Okay. So this is one of the later ones. So the two Macs come after the tax and accounting.
Yes, this will be
Okay.
Tuesday, the 12th of October.
All right. Okay. That gives us time. So we can obviously go through more sections if you need me to. So I'm going to start with study unit 13 then, and we can look at theory, and then I'll try to focus more on the calculations because when they test working capital or cost of capital or even weighted average cost of capital, so study unit 13 and 14, they'll generally put this in one question because it's very, very similar. So it's obviously part of capital budgeting. So when looking at cost of capital, do you know what capital is? That's more of an accounting concept, but it does relate to finance, but in a specific way.
Mhm.
So how would you describe this?
Capital is like cash you need to start up something, or if you want to like start a project or
Yes,
continue a project or an investment. Yes.
correct. Have you
It's the
done,
money you need,
yeah, have you
right?
done the fin modules, the 3701? Have you done that module or not yet?
No, no.
You haven't. Okay, so
Mm-mm.
I just want to try understand a bit more of your background. Okay, so you haven't done that module. Have you done the 2601 module, the fin module?
No,
Also
I only
not.
did financial FAC
The fact
1501
modules.
last year, and I'm
Okay.
doing
Have you
1601
done,
this year.
yeah, have you done DSC 1520?
No, next year.
Okay, and 1630 also next
Yeah.
year.
Yeah, yeah.
Okay,
Next
interesting.
year.
All right, so yeah, okay, that just helps me in terms of scope, so that I'll know what I need to focus on because
Mm.
I just need to know in terms of basics because this is something that comes up a lot in that not FAC, FIN 3701. So capital, if we just keep it simple, it's just the amount of money or funds that you would need to start a project, investment, anything. So the cost here is important because as a business, okay, you can either take out money from the bank in the form of a loan, and we call that debt, or you can get money from investors or shareholders, and that's obviously called equity. So you'll see if
Mm.
you go through the theory, the textbook will talk about the cost of debt and the textbook will talk about the cost of equity. Right? Because you're looking at the cost of debt and equity, this is actually a time value of money calculation. So you have to use discounting and time value of money to determine the cost of debt and the cost of equity. But it relates to something. So either a bond or a debenture. So bonds and debentures are also covered in other subjects. So in
Yeah.
that fin module that I spoke about, and even the DSC modules, but the DSC takes it a bit further because it's a lot more advanced. You do more detailed bond calculations, but in this course, because it's a much bigger course, you'll see when they look at the workings and calculations, it will be quite inverted commas simplified. It won't be as difficult to calculate. So
Oh,
a bond is just an instrument that's a debt instrument. That it's a form of financing, right? So picture
yes.
a business. This business is going to want to raise capital. This business wants 100 million. That's a lot
Hmm.
to get from one bank. Do you agree?
Yeah.
Okay, so what they do is they raise capital in the market through the bond market and they issue bonds and they can issue those bonds or debentures even. A debenture would just be a much smaller bond where you're issuing smaller, inverted commas, loans. But these loans are bought by investors. Right, so these bonds will be used as a form of financing for the business. So this business will get maybe 50 million from one investor inverted commas because you look at the other side of it. Right, you can buy bonds as an investment. Okay, bonds are very low risk. And obviously here we're looking at the financing side. So we're getting people to buy our bonds. Okay. And then the same thing with loans, right? It's a structured contract. So in other words, there'll be a present value, there'll be a future value, there'll be a time frame, so TN, and there'll be an interest rate, right? And when you're dealing with bonds or loans, there could be payments as well. Okay, the bonds, those payments are called coupons. Okay, with loans, they're just called interest payments. All right, and those would be the PMT. Right, so from time value of money, when you're doing TVM, you know that there are 5 variables to consider: the N, the I, the PMT, the FV, and the PV. Do you remember that?
Yes, yes.
Okay. If there's anything that you're not too sure about, then just let me know and I'll expand further. But I'm just trying to summarize basics. So this would be basics from time value of money, where you've got these variables that represent different, let's call them factors in the actual calculation. All right. So for example, a bond will have a time attached to it, and obviously that'll be the N. A bond will have a certain rate, which is called the yield to maturity. Okay, the payment for a bond would be called a coupon. Right, so this is all theory. This you'll see in the actual textbook. If they're looking at the bonds specifically, then they should talk about these variables. Obviously, the bond term would be the N, and then you've got the PV, which is the price, the bond price, and then the future value is called the par value for the bond. Okay, and that's what you get at the end of the bond. All right, so those are just variables. So in time value of money, these variables are universal. They can be used in any application. So when I'm looking at cost of debt, I'm going to be calling it term, yield to maturity, coupon, bond price, par value. If I'm looking at this, cost of equity, okay, then we're going to be using something a bit different. Okay, here you're looking at Gordon's growth model, you're looking at discounting future dividends back in time. All of that can be done on the calculator actually. Okay, so we'll see workings and we'll see how to do that if there are examples that I can help you with in terms of application. Right, capital asset pricing model, CAPM, this is a formula. Okay, it's required return equals risk-free plus beta. Beta is just a measure of risk, and then the market return minus the risk-free. Okay, it's a formula. You don't have to worry about this. It's in the textbook. I'm just writing it in this format. This comes from a different module, but it's about required return. So your risk-free plus the beta or the beta, that's a measure of risk, taking the market return into consideration minus the risk-free. Okay, it's a formula. You'll see it in the textbook, but we'll need it for that measure. Okay, this just gives you a rate, the required rate. All of this can be used in time value of money as well, but applied to cost of equity. So again, same variables, N, I, P, M, T, PV, and FV. Right, if I'm looking at equity, not debts, when I'm looking at debt, I'm looking at the red. When I'm looking at equity, I'm looking at the blue. So N would still be term, okay, or the time frame, the investment term for the actual equity. Okay, so how long are you holding those shares for? I would be the interest rates, okay, or the return on the equity. PMT would be a dividend.
Okay.
Okay, so the dividend would be the payout. So bonds pay interest, shares pay dividends. Right, it's just the cash flow. Okay, the PMT is always the cash flow over a period of time. The PV is the share price, and the FV is your future value. Okay, that can stay the same. Okay, future value or the maturity value, but it relates to the equity. Okay, so those are just basics. Basics in terms of time value of money and how that relates to two costs, cost of debt and cost of equity. Okay, does that make sense so far?
Yes, it does.
Okay, good. All right, I haven't mentioned it, but I should have mentioned it earlier. I am recording the session, so I'll send you the link to the private video, and then you can watch this when you need to, if you need to, and you can go back if you want to revise. Okay, so cost of equity, cost of capital, actually. Obviously, you've got two different costs. You've got debt and you've got equity. Right here, they've just defined the cost. This could probably come up in a theory question. So this could be like multiple choice, maybe. I don't think they'll give this to you in a longer question. In a longer question, it'll generally be calculations with maybe like a recommendation or something that you've got to decide on. I haven't looked at more recent past papers. The last time I looked at past papers was, let me just check. Okay, I've got 2017 past papers here. Do I have 2018? No, 2017 past papers. And I've got older ones as well that I can share with you at a later stage. And you can use some of that to help you prepare. When looking at longer questions, calculations will always be part of it. All right, so this is theory, opportunity cost. They talk about that in economics as well. How much economics have you done?
None. Really.
Not yet, okay. All right, so opportunity costs, this is what I forego. Okay, so when I forego something or what I've forgone, in other words, things that I lose out on. So opportunity cost is looking at what you have to give up if you choose one thing over another. So for example, let's think of something where you have to choose either A or B. Okay, notice it's A or B. It's something that's it's not what's the right term? It's mutually exclusive, not independent. If it's independent, I can choose both. If it's mutually exclusive, I choose the one or the other. So if I choose A, then I can't choose B. If I choose B, then I can't choose A. So when you look at opportunity costs, if you choose A, then you give up B. Right, so whatever benefit you could have possibly got here, you have to take as an opportunity cost. In other words, it's something that will be realized, okay, when you choose something over something else. Okay, and in finance, they often take that into consideration because a decision to go with A obviously has an impact on B, and if I lose out on B, I need to take that as part of the decision making for accepting A. So if I accept A, I need to understand everything that I lose out on, even some of the opportunity costs. And the same with B. If I choose B, I need to make a decision. Am I going to choose B? And if I do I know what I'm giving up on if I don't choose A? Okay, but that's normally part of a longer question. I don't know if that'll come up a lot in this particular module. We'll have to look at past papers, more recent past papers, but it has come up in the past and in other modules as well. Okay. Right, the effective cost of finance is looking at how much does it actually cost the business. And this actually relates to the next chapter. The next chapter talks about the weighted average cost of capital. Okay, that's study unit 14. Right, 14 and 13 go together. The one talks about cost of capital and the one talks about the weighted average cost of capital. So you're just going to take that theory further from 13 to 14. Okay, when you look at 14, you'll see it's a cost, so it's a weighting. So you've got cost of debt, and then you're going to add the cost of equity. But because you've got both, you need to look at the weighting. So the weighting would be a percentage. Right, so in other words, am I using 50% debt and 50% equity? Because remember, a company can choose how much debt or equity they use. They might go half-half. They might go more debt, 60%, less equity, 40%. Or they might go more equity, less debt. So that's what you're looking at when you're looking at the weighted average cost. It's just a weighting. Okay. All right, so theory-wise, the effective cost is looking at what it actually costs the business when taking all those things into consideration. All right, here they're talking about market value of financial instruments. Okay, so you get bonds, you get debentures, you get shares. That's what they're referring to here. Okay, and obviously those payments are going to be made over the life of that investment or that instrument. So interest is paid on bonds. Dividends is paid on shares. Okay, this is just revision. We spoke about that earlier. I'm just highlighting it as part of the theory here in the textbook. All right, let's see if we can get to some workings. Okay, how much of the theory do you need me to go through? That's also another question I need to ask you.
I don't think that much.
Okay.
I mean, as we're going along, and especially if I keep on doing things over and over, you do get familiar with the terms.
Yes.
You
Okay.
know. But I'm sure if you're going to explain something, there's going to be some, some theory
Yes.
in your explanation in any way.
Definitely. Yeah.
But more of this calculations. I'm seeing this formula, this valuation of debt and
Yes.
To
Okay, so cost of debt is looking at time value of money, and we're looking at discounting. All right, so discounting means what? Do you know? This is from TVM. This is from a previous chapter or study unit.
Yes, if you get like a discount rate
Yes, so am I going backwards or forwards in time?
going forward.
No,
No, you're
discounting
going
is
backwards.
going
No, you're
backwards.
going backwards.
Discounting is taking amount that I have back in time. Right, so when you're looking at the cost of bonds or debentures, right, it's important to understand what this actually entails. So let's draw those time value of money variables on the diagram. Okay,
Okay.
and then we need to put these payments and then the rate, which is the I. Right, so let's have a look at this in terms of how it applies to time value of money. When you look at time value of money, you know that there are 5 variables and they have to apply. If I'm looking at cost of bonds or debentures, this is a contract. Okay, they call it a bond indenture. All right, it's just a fancy term for the contract that banks issue to help companies create these products. Okay, so again, let's use an example. ABC Limited. Okay, they're a public company. Because they're a public company, they can issue shares on the JSE, or they can also issue bonds. Okay, obviously these would be bonds that would be accessible because they're a public companies, so businesses can invest in these bonds. Right, so if I'm looking specifically at the bond, they issue that in the market. And obviously a company, an investment bank would help them with that. Right, so the likes of like an Investec or a Rand Merchant Bank, corporate banks, okay, corporate investment banks, they help businesses do that. All right, so ABC wants to raise capital. ABC wants 100 million, okay? They're going to structure this contract, and this contract is going to have a coupon rate and a yield to maturity. So this yield to maturity is just a fancy term for the rates, okay? The payment is called the coupon. Okay, we spoke a little bit about this earlier, so I'm just putting it on the diagram. And then in the actual textbook, you'll see some of it. So this is the first term. Nominal or face value or redemption. This is look at the future value.
Yeah.
Okay, in my example, that could be like the 100 million. That's the face value of the bond. Okay, so if it's the face value, that face value needs to be discounted to get the present value, which is the bond price.
Oh, okay.
Okay, other variables in the question here, just to highlight it, maturity date or redemption date, that relates to the N here. In other words, the time, the period.
Okay.
Right, so the challenge is when you're doing calculations with bonds and you're trying to determine the cost of a bond or a debenture, you literally need to find the variables. You need to find the N, you need to find the FV, you need to find the PMT, the payment or the coupon, and you need to find the yield to maturity. Normally, you'd have to work out the bond price. So that's normally what they ask for. But they can ask for other variables. If they do, then they must give you 4 of the 5. Right, so you must look for 4 given and 1 unknown. Okay, you can't do a bond calculation if you have more than 1 unknown. Right, so if they're asking you to work out bond price, everything else will be given. If they're asking you to work out the future value or the N or the PMT or the yield to maturity, then the other 4 items or variables will be given. Okay, does that make sense?
Yes, yes.
Okay, the nominal value is obviously the future value, and the future value is important because of this coupon interest rates. All right, so when they issue the bond, they're going to say, we're going to pay our bondholders, let's just use 5% as a percentage. Okay, so what does that mean? That means 5% of the 100 million will be paid to the people that have given us, inverted commas, these loans. Right, because remember, the company is going to get money up front, and then the company is going to be paying these coupons month on month on month, or half yearly, or yearly, until the maturity date of the bond.
Okay, so then it
Okay.
will be 5% of, let's say they got
Yeah, so there's an
50
example
million
here.
for the
Redemption
bonds. Oh,
value,
okay.
1,000. So the coupon interest will be 10%. So 100 Rand would be the coupon.
Ah, I see.
Okay,
Yes.
but I want to use a better example. So we'll find better examples. These are just textbook paragraphs, just highlighting the different variables. So as long as you're comfortable with the coupon being the payment, and the coupon must be calculated using the interest rate for the coupon. So there'll be two rates. There'll be a rate for the coupon, and there'll be a rate for the yield to maturity. The yield to maturity is the normal time value of money, which is the discounting rate. The coupon is something that's part of the contract. So they tell the investors, we will give you 5% every year for the next 10 years. Okay, so the rate is attached to the actual bond. This coupon rate will stay the same. It won't change. The interest rate can change. The yield to maturity can change.
Yes. Okay.
Okay, right. So you've got payment, which is this, the coupon interest, the payment on the bond. You've got the nominal value, which is the future value, and you've got the maturity date or the redemption date, which is relating to the N. Okay, so far they've given you 1, 2, 3 variables. They've discussed 3 variables.
Yes.
Okay, they should also talk about the market rate, which they do. There's it there. Okay, so this market rate is that yield to maturity. There's the YTM. Okay, yield to maturity calculations. That's the meaning. Okay, it all relates to time value of money. It all relates to those 5 basic variables. Right, those 5 variables are so important. That's why I spoke about it right at the beginning, because it applies to both cost of debt and cost of equity. It's just a matter of knowing what you're dealing with. Okay, so as long as you've got these 5 variables, obviously you'll have 4 of the 5, because one you'll have to calculate. You can do calculations. So the
Yeah.
textbook has now given you this one. Earlier on, they spoke about the
Yeah.
N. Earlier, they spoke about the coupon, and they spoke about this. All right, this one is obviously what you're looking at in terms of bond price. Okay.
Okay.
All right, so the textbook just spoke about those 4. There's the last one. Okay, the other 3 was further up in the textbook, the ones we just looked at.
Yes. Yes.
Okay.
Yeah. No, yeah.
All right, they do give you more theory here regarding the bond exchange of South Africa. That's basically the JSE, but a specific market. So the JSE has a bond market, and that's what this is for. Okay, buying and selling these instruments. Okay, these financial instruments. Sometimes bonds are redeemable, meaning they can be, inverted commas, cashed out. Sometimes they're non-redeemable. If it's non-redeemable, that means you have to stay for the full duration of the bond. Okay, the bond needs to be paid for the full term. So if the bond is, let's say, 10 years, there's no way to, inverted commas, redeem the bond, right? So it's going to last for 10 years, right? So this whole idea of
And
redeemable
there's
and
no way that
non-redeemable,
you can. Okay, sorry. And there's no way that you can like get out of it faster if you pay more, like sort of pay it off.
you
It's a
can, but
fixed
then
term.
then it would be redeemable. Redeemable meaning you can pay it off over
Oh,
faster. Non-redeemable meaning you
oh,
can't. Right. So yeah. So if you're thinking
yeah,
about a
yeah,
bond, let's
yeah.
just say like a home loan, for example. Okay, a home loan can be paid over a life, faster over the life of the term. So the term could be maybe 20 years, 20 years, 25, 30, whatever it is. Okay. And obviously, if you're making additional payments, you're basically paying it off sooner rather than later. Does that make sense?
Yes.
Yeah, so that's what this is looking at, but it's looking at things from the company's point of view, because sometimes companies issue bonds, ABC, and they issue bonds in the market, and it's not inverted commas favorable. In other words, it's not the best time to issue those bonds, but they do so anyway. So sometimes they want to take their bonds back. In other words, they want to redeem their bond and they want to issue new bonds. That's a much more complex consideration, and I don't think they cover that in this module, but they do cover it in the INV modules, the investment modules, that they cover
Oh, okay.
in detail because it's part of an investor's consideration. Right, but I don't want to cover it if we don't need it, but it's like your home loan, paying it off sooner or later.
Okay.
Okay. All right, so if you look at the calculations here, the steps determining the current market value of the bond, what is this asking you to do? Working out the market value. So in other words, what is the current price? Does it make sense?
So the PV. So the
Exactly.
PV. Okay.
Okay, so PV is just the current value or the bond price. Okay, it's basically looking at what is this actually worth today, right? And how do we do that? We take future amount, so the future value, we take the term, we take the PMT, and we take the I, and we discount everything back to time zero. Okay, so you can
Yeah.
use maths to do this, but if you use maths to do it, then you need to look at all these fancy formulas. You don't need to do this on a very, very big formula because you have the financial calculator. The financial
Yes.
calculator can do everything for you. All you have to do is type in the values, right? So, just a tip when you're doing exams, if it's multiple choice, then it's not going to make a difference. Whether you're doing it using formulas or whether you're doing it using the calculator, they won't know as long as you get to the right answer. This is always the quickest, fastest, and most accurate way to do it. I don't know if they're going to give you written questions if it's an online exam. They can just give you space to type in
Mm,
answers or upload
yeah, I
a.
don't know because they said that they're going to specify either we have
Okay.
to use the formula or we can use our
Oh,
calculator or we have to use the
yeah.
tables.
But
But this
remember,
was, I don't know about this year and I don't
yeah,
know how last year was for this module. So I
yeah,
don't know if they are, I
yeah.
don't know.
Remember, if they do ask you multiple choice, then obviously the answers will be there. Then you just need to choose the right answer. Then you can always use the calculator. Does
Yeah.
that make sense?
Yeah, yeah.
Okay.
That's,
If it's a written question, I would just state then using the calculator, and then I would write down my values or variables, and then I would solve using the calculator. But I'll always state what I'm using. Right. I don't know how let's put it strict they are in terms of that. I don't know. For example, if they ask you to work out the present value, and there's no instructions. In other words, they don't say you must use the formula or you must use the calculator or you must use the tables. I don't know what they would prefer. For me, calculator's the best because, as I said, it's quick, it's accurate,
yeah.
and it's much, much, much better in terms of workings. So I'm going to do it using both methods if we need to, but I'm always going to ask you to rather use the calculator because that's the best method.
Okay, no
Okay.
problem.
Right. So let's have a look at some example. Okay. Here they're just talking about the yield to maturity. What is that? What variable?
That is the interest, the
Exactly. That's
interest rate.
not, don't say
Yeah.
interest because remember, we're looking at bonds. Interest would be the coupon.
Okay,
Okay.
but
The
it's the
yield to
I,
maturity is the rate that's used for
right?
discounting. Yes. It's the I. Okay. They call it the yield to maturity. It's the I in the TVM calculation.
Okay.
Okay. You can use net present value as well to help you do calculations when you have different cash flows. It's possible to
Yes.
work out the I. Okay, then you've got to use the cash flow function on your calculator. Okay. Have you done that before?
Okay.
Have you looked at NPV on your calculator? Have you looked at
Yes,
IRR?
and not on my calculator, but we had a long question for an assignment where we had to work out the MPV.
Oh,
So,
okay,
like, I
interesting.
know all the steps, and then we had to use the tables.
Ooh, shit, that's a very, very, very long way to do
Hmm.
it. But
Yeah.
if
Well,
we get to an
yeah.
example, I'll show you how to do it on the calculator. It's much, much easier. It's literally
Okay.
one step. Type in the values and then you press a button and it gives you the answer. Okay, so let's see if we can get to some of those. Okay, calculating after tax costs. This is something to consider from an exam point of view. Why do we need to look at after tax, not before tax?
Because we still have to pay the tax. So,
Okay, that's correct in a way. It's basically because interest is tax deductible. So it's not that you're paying tax. So yes, you would pay tax if this was a let's say an accounting scenario. So net profit before tax, then you would less tax, and then you would have net profit after tax. Right, that's accounting.
yes.
But when you're looking at finance, you're looking at the cost of debt. Right, so if I take out a loan and I'm buying a building and I'm running a business from that building. Will that loan have interest?
Yes.
Definitely. will that interest be tax deductible? In other words, when I'm running my business from this building, okay, can I deduct my interest from my tax return?
I'm going to say yes now because you
Yes.
mentioned it's tax deductible.
Okay. And
But
that's why businesses, see, this is theory. So if you're looking at which is better, debt or equity, debt is actually better to some extent because of this tax deductibility of the interest. That's why businesses don't mind taking out loans because they know whatever interest they pay, it's tax deductible. So they actually get a benefit and it's going to reduce the cost of debts.
do you pay back do you deduct the interest on a yearly basis or is it only
Yes.
at the end?
It's on a yearly basis. So remember, companies need to file returns once a year to make sure they reconcile everything. But it depends what they're reconciling. If it's their income, then they'll do that twice a year because they also need to have provisional tax. But if I'm just keeping it simple, the income tax will only be done once a year because they look at the 12 months. They look at the whole year. If it's VAT, then they'll even look at it monthly. But yeah, if you're looking, so if you've done the tax 2601, I think that's individuals. I think 2602 is company, something like that.
We're doing, yes, we did companies now.
Okay, then this is the company's one that I did.
Yes,
And then the individuals, the other one, something like that. I forget the numbers, but I know one of them covers like businesses. And when you look at the business, obviously there's a calculation for taxable income. That taxable income calculation is done once a year because you basically need to wrap up your tax affairs with SARS. So they look at the full 12 months. So they'll ask you, how much interest did you pay over the 12 months? Let's say you paid, I don't know, R1,000,000 in interest because of your bonds, and then they're going to allow you to deduct that from your tax. So it'll be a deduction. It's a deductible.
So it's fully deductible if it's a 1 million rand.
As long as it's for
So
business.
it's not limited to something.
No, as long as it's for business. It has to be for business. You can't take out loans to pay staff, or you can't take out, it needs to be something that's business related. So if you take out a loan to buy machinery, equipment, vehicles, as long as the vehicles are for delivery and for business purposes, then yes, you can deduct it. Yeah, so the rules are quite specific, but if it's for business purposes, you'll be able to deduct it. Okay. All right, so 12% is the rate, which is what we've got here. Notice they've taken out the tax. So how much is the cost of debt actually? 8.64%. Do you see that?
Yes, I see it.
So you just need to remember how to take out tax. Taking out tax is literally 1 minus the 0.28. That's how you take out the tax. Right, so if it's 12%, you would times it by 0.72, or 1 minus 0.28 gives you the 8.64%. That's how you get the cost of debt. Cost of debt is always after tax because you get the tax benefit of deducting the interest. Okay. So that's something that you need to know because when you're doing calculations, whether it's study unit 13 or 14, you need to always take out the tax. Whatever the amount is, once you've calculated, this 12% could be calculated. This could have been an I from a longer question. And then once you've got the I, you take out the tax.
Okay. No, I can understand that.
All right, let's see. Okay, here's some examples. Okay, here's one. All right, so if you look at the required, determine the current market value of the debentures using a formula. Okay, you can look at the textbook because they'll probably give you an answer with the formula. Let's do it on the calculator. All right, so on the calculator, you need to identify values. So here's the example. Okay, so if you're looking at an example where you're determining the current market value means you're looking for the PV, the price. Does that make sense?
Yes.
Okay, so if I read the question, pull out values. Exco Limited holds 1 million debentures par value. So what is that? Future value. The annual interest coupon payment is 15%. So 15% of a million is 150,000. Do you agree?
Yes.
That's the PMT. Okay. It's redeemable after 5 years at face value. So that's the N, 5 years. Okay, the current market return for similar debentures with a life of 5 years is 20%. This 20% is representing the yield to maturity. Do you agree?
Yes,
Okay,
yes.
they're also telling you that you need to assume a current company tax rate of 28%. Okay, 28% is going to be looking at the cost of debt. All right, there are other things to consider here. Effective cost of debt, then we'll use that. Okay, so if I'm looking specifically at the present value calculation, okay, what is my FE going to be? $1 million. What is my PMT going to be? 150,000. What is your N going to be? 5. What is your I going to be? Your interest rate? 20. Right, if you solve for PV, what do you get on your calculator?
Let me quickly.
See, they've used maths to do it. You don't have to do it this way. It's much faster doing it what I've said. Okay, I'm going to grab my calculator. Okay, on your calculator, so on your sharp, you're going to put in the values. You're going to insert N as 5. You're going to insert I as 20. You're going to insert payment of 150,000. Or you could even type it in. You could type in 1 million times 15% and you'll get 150,000. And then future value, put in 1 million. And then you're going to solve for PV. Okay, on my calculator, I get this answer. Okay, let me ask you, what did you get?
Let me just. And then comp present value. 60296.
Ooh, no. It's not 602. Clear your memory. Clear your memory. Clear your memory. Let me search for a picture of your calculator so I can look at your buttons. Let me just open up a browser window. Okay, do you know how to clear your calculator?
Second, alpha, clear memory.
What sharp version is it? It's a sharp what? What's the module number?
EL.
Yeah?
It's EL738 XT. But yeah, all the 738s looks. I can never get my specific ones. So I just work off that.
Okay, yeah, that's fine. I just want to look at what it looks like. Okay, so I just want a picture of it, so at least then I can see what buttons you have on screen. Okay, once you've cleared the calculator, I think if I remember correctly, you've got to type in the value, then press the number. So, for example, you type in like 100,000, then you press PMT. I've lost your audio. Are you still there? Okay, I see the mic's still on. I'm not getting any audio. All right.
Okay, now I got another amount. Redoing it.
Okay, what did you get?
508873.
Oh, no, still not right, eh?
Still not.
Okay.
Maybe I'm doing it in the wrong order.
Right.
Yes, that's exactly the one. Yes.
Okay, that's your calculator.
Yes.
All right, so you would have to clear this thing. So let's see, where's the shift? The master clear, M clear.
Yeah.
So second function, M clear. So this button, second function, alpha.
Yes.
And then on your screen, it should have like yes or no or something.
Yes, yes. And then I just press 0, then it clears it.
Okay, so the whole thing is cleared.
Yeah, clear
Okay, so then you need to type in the value. So type in 1 million. 1,000,000.
Does it matter what I do first?
No, it doesn't. As long as you have all the variables in the calculator. So just type in 1 million and then press the future value button. Press that button.
Yes. Okay.
Then type in 150,000 and press this button, the PMT.
Oh, okay.
Then you need to put in 20%. and press the I over
Yes.
Y. Then you need to put 5 years in. So press 5, press N.
So do I do 20% or just 20 and then press
No, you
I?
have to put in the percent as a percent. So you don't
As the
put 0,
percentage.
2, you put in 20 as 20. If it's
Yes,
20%,
20 and
the
then,
calculator uses percentages. So if it's
okay, so
20%, you put in
yes,
20 and then you press that button.
yes, okay.
Okay, then you type in 5 and you press N.
Yes,
Okay. Then if I remember correctly, I think you've got to press comp and then you have to press
yes,
the PV.
PV. Okay, now I've got another different amount again. It's 850469.
That's the right answer.
Am I getting closer? Oh, okay. Well, come.
Okay, that should
Okay,
be the
because
right answer.
how I did it, I did my yield to term first, then the term, then the coupon, and then the future value. I don't know if that made it. It shouldn't be making a difference,
It shouldn't be
but
making a difference. But let me just
I'm
write
gonna
in that
quickly.
value. It should look exactly like this. And this is more accurate. That's why I like the calculator, because there's no rounding. Okay, then you can round this
Yes.
off if you want to. That should be the answer exactly.
Okay. I'm gonna quickly just retype it all in to make sure that I am just not messing it up. But I'm gonna start with like N so I can know
Yeah,
it's
you can start with
20%.
any value. Doesn't matter which one.
Anything,
Let's
yeah.
try find another example. This was the first one
6%.
that was looking at. Okay, this one's looking at the discounting. Let's go back to the question. Yeah.
Okay. Okay, now I did get that
Yeah, you should be getting this
850469.
figure. Just make sure you clear everything and then start over. So when you do a question, clear everything, then do it. Clear everything, then do it. Every question must be done separately.
Yes.
Okay.
Okay.
Notice this is how I would show it if this was a written exam. Okay, but I would just put a heading here, calculator. And then I would show it. There's the I, there's the coupon. This is wrong. Okay, they've used different variables. I would have used PMT there. I would have used I here. I would have used FE there, and I would have used N there. And then I would have written that down, and then I would have written that, 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 and then I would have said solve PV, and I would have put equal, and I would have written the amount, and I would have said a calculator, that type of thing.
Oh,
So
okay.
here they said use formulas, but as I said, you don't need to use formulas because it's so much longer, because you have to use these. It's more maths. That's all. This is just testing your maths. It's not
Yes.
testing your finance at all, actually. But yeah, you never know. You might need to do this, but it's just a formula, and you're plugging values into the formula. Maybe just to mention what this relates to. This is the present value of the coupons, and this is the present value of the future value. That's all. And then you're adding the two together. So this is an annuity, okay? And this is just a normal time value of money discounting. So this is a discounting for an annuity. This is discounting for a normal future value. Okay, but as I said, this is more TVM. Okay, and if you
Yes.
do more of the DSC, the 1630 especially, that one is all about time value of money. But it doesn't matter here. As long as you've got the calculator, you can do all of this in one step.
Okay.
Okay. Happy with that one?
Yes,
All right.
yes. I
Maybe
don't think,
just,
I hope they don't do the formulas, but if we get clarity on how the exam's going to go and they say, it's not
yeah.
going to be multiple choice question, then I'll just get it in my brain,
Yeah, if it's
At
multiple
least I can
choice,
still look at the formula.
yeah, if it's multiple choice, calculator always. Don't even worry about this stuff. Okay, the maths. Okay, if you do need to go through the maths, then we can always cover that in more detail. But as I said, it's very mathematical. It's just an annuity. Okay, and as I said, it's actually covered in DSC. But if you haven't done that module yet, you'll probably do it later, or maybe you won't have to do it. It all
Yeah.
depends. Yeah. Okay, but
Yeah, no, I saw a DSC model in my future.
okay.
I'll probably take it next year, yeah. So
Okay. It's actually better to take it sooner rather than later, because the DSC is actually nice in terms of basics, because then it makes all of this so easy, because then you have all that knowledge. Then when you look at this, right, you already know what this is because you've done the DSC. Now you're looking
yes.
at this, it's a little bit confusing because you haven't done the DSC. Yeah, so I don't know why they haven't recommended some of them. I know with some modules you have to do certain modules first before you can do other ones. So I
Yeah.
would like if I was structuring it, I would ask students to do DSE first and then do the MAC later, or the FIN, or even the INV, all of those later. Yeah.
Yeah.
Okay. Let's just have a look at the after tax. Okay, so here they said effective after tax cost of debt. Okay, here they want you to use IRR. Okay, IRR is internal rate of return. This is looking at cash flows. Okay, the CF. And what do they want you to use? They want to use 14 and they want to use
And
20. Looks like it. Okay, calculating using, okay, this requires tables though. Okay, so they want you
Yes.
to use the tables. And then the second one is use the calculator. So yeah, if you use the calculator, let's have a look. Where's the calculator? Yeah, there's the calculator. Here they were working out the IRR. This was part 2 or part 1. Which number was that? Okay, yeah, this is part 2. The effective after-tax cost of debt. Okay. Calculator work. And then they said, assume the current market value is the same as the value calculated in A. All right, so A, B, and C all cover the same scenario. So you need to use these measures when doing those calculations. Right. Remember, it's all time value of money. So the N, the I, the PMT, the future value, and the PV. That's what you need to do any of those workings or calculations. Right. If you're doing IRR, then you need to put in cash flows. Then you need 5 years. Year 0, year 1, year 2, year 3, year 4, and year 5. Okay, you need 5 years. That's the only difference. So if they're asking you to do that here, you need to draw up a table. Right, so they've drawn a table, but this table is showing the table factors. Okay, those tables are probably in your textbook. Do you know what page the tables are on?
No, I have them, yeah.
Which page is it on? Is it in this textbook? Should be at the end or the back.
In the middle. No, it's in the middle.
It's in the middle. What page?
142, 143, 144.
Okay.
145.
142, 143. Okay, there's the tables. Right, the tables, just to explain what the tables do, the tables just help you to do discounting when you don't have a calculator, because there's the bracket. Do you see that bracket? This was part of the formula.
Yes.
Remember that? Remember that one equation. This is working out the present value of an annuity paid at the beginning or at the end, depending which table this is. This is at the end. Right, so you're going to be using these factors to do it. But as I said, this is a very long method to calculate something that's a little bit easier to do on the calculator. So if we go back, where were we here?
A little bit down.
There's it. All right, so we've got the values, we've got the amounts, but now here they said the effective after-tax cost of debt. So if it's after tax, do you agree you need to take the 28% into consideration, because that's tax in this question, the 28?
Yes.
Okay. Right, so if you're looking at this, here they said calculate the IRR, okay, 14%, 20%, 22%. Okay, because you're using different percentages, all right, you're going to have to discount those things back at that percentage, because remember, you're trying to work out the net present value. Okay, so net present value is basically your PV. Okay, so here they're wanting you to calculate what is the inverted commas here, this question mark. What is the IRR, the internal rate of return, okay, if I'm using 14 and I'm using 22? Okay, remember, if you're using two different amounts, we know what the rate was. What was the rate? 20%, right?
Yes.
That was given in the question. Okay, this 20% is actually calculated using the discounting of future values back in time. Does that make sense?
Yeah.
So for example, if I draw the loan was $1 million, right? and we're going to have coupons of 150,000 every year for 5 years. Do you agree?
Yes.
Okay. So if I had to draw up a table, I would have to show year 0 is 0, year 1 is 150,000, year 2 is 150,000, year 3 is 150,000, year 4 is 150,000, and in the last year I'll have 1,150,000. That'll be year 5. And then you need to use the discounting on the calculator, the cash flow button. And then you're going to get the IRR. Okay, so let me do it on my calculator. Do you know how to do this on your calculator?
No, I've only done the long way around.
Okay,
so
then I'm going to have to
do
explain the steps.
cash.
Let me just work it out here quickly. All right, so I need to go to my cash flow. Let me just put in these values: 0, 150,000, 150,000,
Yes.
150,000, 150,000. Then I need year 5. Year 5 will be 1.1, 150,000. Okay, let's go back. Just check my cash flows. 1, 2, 3, 4. I should have another cash flow. I've left one out. 5 years. So 150,000. 1,150,000. 1.5 million. Okay, let's solve for IRR. Let's go back. Okay, so you need the price of the bond. We're missing our initial investment. What was our initial investment here? It was the bond price.
Million.
It's not on this page. It was the 800,000. Okay, it is on the page. Here's it. There's it. Okay, that's going to go here. This will be minus 800,000. 850, 417. Okay, comma, I think they rounded that off. All right, so minus 850,471. And then solve. Escape, solve for IR. IR takes a while to get because it's it uses a Newton method. It's a repetitive, yeah, and then you get 19 points. You get 19.999993962. That's on the calculator, and that should be one of their workings here. Where's it? Okay, yeah, they've done it here using the formula, and then okay, calculate IRR using time value of money. Okay, here's it. Here's the calculator steps. And then if you press IRR, you'll get 20% or close to it. You'll get 19.9999. All right, so, okay, on your calculator, you're using the sharp. Okay, so don't put in 0. This is not right. You need to put in the plus. Okay, this is clearing. Okay, that's fine. You can clear everything. I'm just trying to understand what they're saying here. Okay, clear everything. Enter data sets. Okay, there we go. There's the enter data sets.
Bye.
All right, let me go back to that picture. Let me change this to where's my... Here. Okay, so clear the calculator again. Let's find that cash flow button. Okay, here's this cash button. Do you see the CFJ here? That's the button. This cash button is a second function because of the color coding. Okay, so just to go back to the notes so we know what to press on your calculator. Okay, you're going to type in, so you need to put it in as a negative. Negative 850,471.
Enter.
Well, when you press enter, was that cash flow? Were you in the cash flow function? Did you press the CFI?
No, CFI, then second function, then CA. So I'm doing exactly so. It's CFI, second function, and then CA.
Do you see any data sets on your screen?
No, I don't.
Okay, it's fine. Let's just try it. Let's just follow their steps and see if it works. Okay, next step, make it a negative. So put in a negative 850,471.
Yes. So,
and then you need to put in
enter. Okay, there, yes. Okay, I've got the data set
Okay,
here.
that's good.
Yes.
And then you've got to
Okay.
put in 150,000 four times. But you've got to press enter every time. So I would do it four times. So put 150, press enter. Put 150, press enter. Put 150, press enter. Do it four times.
Okay.
Okay, then you've got to put in this 1.15 million. 1,150,000 basically. 1.15 million.
Okay. Enter.
That'll be cash flow number 5.
Yes. Okay.
Okay,
Shows
and
like
then
that.
follow the steps here. Clear the cash flow register. So then press on/AC. Then press second function cash.
Second function CA. Okay.
Okay, then you got to scroll, I think. You've got to press the arrows up and down. You've got to look for, or press comp IRR, looks like it's.
Okay, let me see. And press comp to get IRR.
Do you get the
Okay, yes, I'm
19.999?
getting 19. Yes, yes.
Okay, there we go. Right, that's how you would do IRR on a calculator when you have cash flows. Right, so what must you do? You need to draw up this table.
Yes.
Okay, I just
But I
draw
just
this
want to also
table and I just insert the values on the calculator. That's all.
Okay.
Okay, the first value
I
is
just want
negative.
to,
The other values are all positive.
so I'm just trying to see now from what we did and we worked it out. Okay, 85471.
That
And
was the
then the
present value.
150. Yes, yes, that's the one. That's what we got. The market value.
Yeah, because remember,
Okay, and then yeah.
okay, this is not the best of questions because in a question like this, you're not going to be using an answer from a separate question. Does that make sense? In the
Okay.
exam, if you're asked to work out IRR or the yield to maturity, they will give you the FE, they will give you the PMT, they will give you the I, which is the yield to maturity. No, that's what you're solving for. We're looking for IR. They'll give you the N and they'll give you the PM, the PV. Do you see that? Okay, then you will solve for the IRR. If it's given in cash flows.
Okay.
Okay, so you need to know when to apply which method. So that's why I'm saying you need to look at what they're asking you to do. Right, in this question, they're asking you to work out IRR. If they're asking you to work out IRR, then you need the cash flows. You need cash flows for the start, during the life, and at the end.
At the end. I just want to ask, where did you get these cash flows? So it's 150
I
and
just had the
then
diagram.
150, 150.
150 is the coupon. 1 million is the
Yeah.
par value. N is 5 years. And PV was calculated earlier.
But this year 5, how did you get that at a 1.15?
Because what do you get at the end of the bond? You get the maturity value of $1 million plus the 150,000 interest.
Okay, so it's the
because
150
that's cash
plus
flow.
the million. Okay.
Okay, because let me just use a different color because you're discounting all the cash flow back in time. So even the 150,000 in year 5.
Okay.
Okay, because there's 5 years of interest.
Okay, yes.
Okay.
Always start. So now we're just starting with the 850 for 7 years. It's 471,
well,
but
you need
not
the
really.
present value.
Usually be 0.
That should be given if you're asking to work out IRR because you need 4 variables to work out the 5th one.
Yes.
Okay.
Okay, so they just said use the present value for the previous question, and then we slotted it into our cash flow.
Okay, remember, this is just theory in the textbook. They're showing you how to do the workings. All right. Obviously, past papers will be questions, and then you'll be using the workings. Does that make sense?
Yes, yes.
Okay, so you've looked at how to do a calculation with variables, where you just plug in the variables and solve for something. And here's another skill. This is looking at the cash flow button.
Yes.
Okay, you have to know how to use cash flow. You need to use it sometimes. Okay, I just want to see. Maybe we can just wrap up this section. At least then we're not halfway in between. Then let's just see what else is there. Okay, so all right, so that covers the cost of debts. Here you've got a loan question. If it's a loan question, let's find an example. Okay, there's no example. They're just talking about the different rates that are present. JIBAR is a Johannesburg Interbank rate, and LIBOR is the London. So this is used to help price rates in the market. Okay, this is theory. It's additional content. Okay, cost of equity is also a calculation on the calculator, financial calculator. Okay, we spoke about it earlier. NI, PMT, FV, PV. This is what you're going to be looking for. Normally, you'll work out that one, but you could be working out other ones. If you're working out this, then they'll give you all of the other ones. Does that make sense?
Okay. So they'll always give me 4 out of 5.
Well, not always. It depends if the equity pays dividends.
Oh, okay.
Okay, dividends, then you'll have PMT, because PMT is a dividend. It's a cash flow. If there's no dividend, it's 0, then you don't have to worry about it.
Okay.
Okay. Gordon growth model is just this. PV equals dividend 1 over R minus G. That's the formula. Okay, this is used. There is no way of doing this on the calculator other than typing it in using that. Okay, this is when we have constant growth. So you have a dividend, T0, T5, and every year the dividend will increase by, let's say, 5% or 2%. Okay, so the first year's dividend, let's say the first year's dividend is 5 Rand. Okay, the next year's dividend will be what's 10%? What's 22% of 5 Rand? Let me just work it out. 5 times 1.02, it's 5 Rand 10 cents. Okay, times that by 1.02, then I get 5 Rand and 20, well, 20,2, comma 202. And then if I do it again, the next dividend will be 5 Rand, comma 30604. And then the next dividend will be 5 Rand and 41216. Okay, so Gordon growth, the word growth is when the dividends increase. In other words, when you're paying more dividends year after year after year, then you need to use that to work out the cost of equity.
Oh, okay.
Okay. Let's see if they've given
So
you...
I just want to make sure, so you said there on top, so it's PV equals dividend over, is it N? No, it's not N. The
R
required
minus
rate
G. I just use R minus G because this comes from the investment module, unfortunately. It's different modules use different variables. That's the one I'm familiar with. That's the one I know and remember. In your textbook, it's KE minus G. KE is looking at the required rate of return. Okay, the RR. Okay, don't worry about what you're putting in the formula, if it's an RR or if it's a R or if it's a KE. The R is just representing the rate that's applicable in the market to discount the cost of equity. Does that make sense?
Yes.
Okay, so whether it's a KE, whether it's a R, whether it's a RR, it's just the required rate of return for discounting for equity. Okay, so you need the actual dividend, whatever the dividend is, but it's dividend 1. So remember the diagram, T0, T1. It's not the dividend here because that's dividend 0. It's the dividend here because that's dividend 1. Does that make sense?
Yes, yes.
That's the dividend that you're going to put in this formula. Then you're going to put in the R, which is the required return, and then you're going to put in the growth rate, whatever it is.
Okay.
Okay.
Also give it to
Yeah, they don't.
I'll go through this, and then familiarize myself with.
Yeah, it's just a formula.
With a formula.
I just want to see if there's any more time value of money. Yeah, here's an example. See, there's one. Okay, so I'm just going to do this quickly just to show you how to do it. Okay, so super limited dividend 1 Rand 30. Okay, trust paid. Trust paid means T0. Okay, the expected rate of return on the shareholders' equity is 14.5%. That's the R. The growth here is 8%. So I write down PV equals div 1 over r minus g. The first dividend will be 1 comma 3. Because it's just paid, it hasn't got the growth, so it'll be 1 plus growth. Okay, over the r minus g, the 0.145 minus the 0.808. Okay, because I know what the growth is, I'm going to replace that with 0.08. Right, and then if you type that into your calculator, on my calculator, open brackets, 1.3 times 1.08, close brackets, divide by open brackets, 0.145 minus 0.08, close bracket equals, I get 21.6. And that should be the same as the textbook.
Yes, it is.
And it is. Okay.
Okay.
Right.
So
this
did
one's
you
the same.
see a listed company?
This one's the same, except they've just rearranged the formula. Okay, so when you have PV equals div 1 over r minus g, how good is your maths? Can you make r the subject?
Yes.
Okay, if your maths is good, you don't have to study all these formulas. They've just made r the subject. If you make r the subject, you're going to get from here to there. Does that make sense?
Yes, yes.
Okay, so
I just have to keep my head because you're using different like letters. I'm just trying to be like, okay, this is this and this is this and
yeah, it's the same
but
formula.
that's
It's the Gordon growth. This is just Gordon growth, which is the KE. So it's the KE there. That's all. Does it make sense?
Okay, I see it twist around. Okay, yes.
Okay, so you can just make this the subject. That's all. So basically, take this to the left. So PV times R minus G equals dividend 1, and then multiply out. So I'll have PV times R, so PVR. And then I'll have minus PVG, okay, equals dividend 1. Okay,
yes.
And then obviously if I want the, what do they want here, the R on its own, then I'm going to take everything to the other side. So then I'm going to have the PVR equals the div 1 plus the PVG, and then I'm going to divide by PV, divide by PV, divide by PV. And if you do that, you've got div 1 over PV. This PV cancels with that PV, you're left with the G. Do you see that?
I see.
That cancels, you're left with the R. So you're going to have R equals div 1 over PV plus G. It's the same formula. Right, so you can just use one formula. You don't have to use so many different formulas. It's the same thing. It's the principle that's important. This is Gordon growth. That's important. Okay. Right, then I think we've finished that section at least.
Thank you.
It's just the cap M. Cap M is easy. It's just a formula. I showed you that formula earlier. I just want to see if they've given it to you in the textbook. They should have. Yes, they have. There's it there. Okay, they've used that notation. Right. There's the formula. This is the one that I wrote earlier. Required return equals risk-free plus the beta times the market return minus the risk-free, close bracket. That's what you saw earlier. It's all there given in the textbook. Okay, so if they ask you to use cap M, you just use that. Right, it's very specific. So depending on the question, okay, when you're looking at the cost of equity, okay, cost of equity can be calculated using normal dividend discounting method. That's method number 1. Number 2, you can use constant growth model, Gordon growth. Number 3, you can use CAPM. All right, that's why in this chapter, they've given you these 3 different methods. All of these methods give you an I, which you're going to be using to value equity, because that's the cost of equity. Does that make sense?
Yes, yes.
Okay, so this is why you have this chapter. You've got 3 methods to calculate the cost of equity. Once you've got the cost of equity, then in the next chapter, you'll use the weighting to determine the weighted average cost of equity, because you're looking at the debt and the equity. Okay. Right, I think I've concluded that, yeah. So at least we can stop there. At least then we've looked at a whole section. What
I'm
I would
going to go
suggest
on
you
to
do,
the next one, then I'll let you know how it goes.
Yeah, I think what I would suggest you do is just try practice. Do these questions and see if you can get them right using the calculator. If you have problems with any of them, then we can always discuss them and I can quickly do them and show you how to complete it.
Okay.
Okay.
Perfect.
But yeah, there's lots of workings here I see, which is nice. At least they're giving you practice examples that you can try. And then see how it goes. Whack, as I said earlier, was just a weighting. I'm going to write down the formula here quickly, and then maybe when you go through it yourself, you can just keep this in mind. I think I do have a video on this actually. I'll go check what I have, and then I'll see if I can share stuff that is relevant. So this would be cost of debt times the weighting for the debt. And then you've got the cost of equity times the weighting of equity. That's all. Okay, so this cost of debt comes from study unit 13. This cost of equity comes from study unit 13. This weighting is if I'm using 50-50, 60-40, 70-30, whatever it is. Does that make sense?
Yes, yes.
And you just need to multiply. Don't forget the cost of debt after tax. You need to take out the tax. Okay. All right, Johnny, is that all right for this week? Are you okay with what we've covered so far?
No, that's perfect. Yes, it's perfect. I'm going to go through this. I'll do the study unit 13 and then 14.
Yeah, try 13th practice and see how you do, because that'll be good practice to test your calculator skills a bit more. Because once you've got it, then you can actually do any working. It doesn't matter what working they give you.
Yes. Okay. No, I get that. Thank you so much. I appreciate
you're welcome. I'll send you the links in that, and you can obviously review anything. Sorry, I did try rush it a bit just to cover that last bit. At least then we've covered it.
No, not a problem. Like the best way is to figure it out to, some degree by myself anyway. Then I can come back to you.
Okay.
You with better feedback as well.
Okay.
Like how I'm actually doing.
100%. All right, Zonika.
Okay. Thank you so much. Enjoy your afternoon.
All right, you too.
Thanks.
Bye.
Bye.